So over the last 12 months as well, one of the things we were quite pleased with was avoiding any major catastrophes in the portfolio. As we've said many, many times, one of the core things we're focused on is preservation of capital, and one of the best ways of doing that is by avoiding things which have a large material loss. Gold was probably one of the largest contributors in industry portfolios to negative returns, with fell 23% during the year. Now, that was really a function of the ancillary of equity markets or the world becoming a better place. Gold had been priced in this contagion effect, or this expectation that the world was going to fall apart, and ultimately, as investors became more and more comfortable that it wasn't, then we saw that that pricing effect came out of gold with that fall of 23%. Now, the other part of the market which we've avoided completely in recent times is the interest rates, and in particular duration. So we saw most recently at the end of the financial year that interest rate markets started to fall very, very precipitously. And this was as markets started to price in, specifically off the back of the Fed Chairman Bernanke's comments around the potential for the easing, quantitative easing in the future, started to price in materially higher interest rates in the future. So we saw from the beginning of May through to the end of June, for example, the US 10-year bond rise from 1.6% to close to 3% over a matter of literally weeks. Now, as I mentioned before, we don't have any duration fixed income in the portfolio. We've seen that as being excessively overpriced for some time, and as a result of that, we're able to avoid some of the capital losses which are being incurred in the industry as a result of holding such overpriced assets.
The Australian equity market for the year to June 2013 finished up 22.8%. It was a strong performance. The sectors that tended to outperform were the financials, the listed property trusts and the industrial sectors. The laggards over the year were the energy sector, which only finished up 5%, and the big drag on the market was the resources sector, which actually finished down 9%. So the reason that resources finished lower was slowing growth in China and an increase in supply of key commodities, leading to lower commodity prices. The Australian equity portfolio actually finished the year up 25.6%, so outperformed the market by about 2.8%. And the key drivers of that were individual stock selection across a number of industrial and financial stocks, but also a key underweight to resources exposure.
So in terms of the outlook for the next 12 months, we continue to remain extremely positive. It's fair to say that we're not expecting the same sorts of returns that were generated by the market over the last 12 months, and that's because the level of mispricing going into the new financial year isn't anywhere near the extent that it was over the last 12 months. However, that being the case, we still remain extremely positive on the global growth story and the continuing recovery of global growth, particularly driven by the US. As a result of that, we're expecting good contributions from the equity parts of our portfolio. We remain comfortable not holding any duration fixed income in the portfolio, as we expect that interest rates there will continue to rise over the short to medium term. The final part of the portfolio that we are far more comfortable with now is the alternatives part of the portfolio. It's fair to say from the period of about mid-2011 through to late 2012, this was the part of the portfolio that contributed very little to overall performance. It didn't detract in aggregate sense negatively, but in the way that it had contributed in years prior, it had been absent. It's pleasing to see in the last 6 months that that's now started to make quite a meaningful contribution again to the bottom line. And again, we're far more comfortable that the environment for these managers to generate strong positive returns over the next 12 months is far more conducive as well.
We expect the next 12 months in the Australian equity market to revert back to long-term type averages of 7 to 10%. What we do see is a good amount of opportunity within the market, and we think there'll be quite a large variance between the stocks that do really well and the stocks that do poorly. So what we're attracted to is sectors that we see good structural growth in. Sectors like online education, online services, the payment system. We really like healthcare space with the ageing demographic. We think that's very, very visible and a certain growth stream within a number of economies. Where we do see some weakness continuing is in the resources space, and we're less attracted to that because we think that exactly at the time that the capex booms ended and production volumes are uplifting in a number of key commodities, China's growth is actually slowing. And that means that commodity prices are likely to stay lower than they have been in the past few years, and we don't expect returns to be as good from that part of the market. So we're also quite attracted to stocks that have, and a lot of industrial stocks fit this bill, that have offshore earnings, because our view is that there is an ongoing depreciation of the Australian dollar over time. So they're some of the key segments that we are looking to exploit. We're reasonably optimistic about the outlook for international equities within the portfolio over the coming 12 months. We prefer international equities to domestic equities on the basis that the US is actually improving, Europe's stabilised, Chinese growth, although slower than a few years ago, has actually now stabled, coupled with the fact that we believe the Australian dollar continues to be overvalued, and as unhedged investors we can gain the benefits of a falling currency.
So whilst we benefit materially from the way we construct the portfolio in terms of managing risk, and that is we don't want any part of the portfolio to be excessively exposed to a single risk, be it equity risk, interest rate risk or currency risk as three examples, there are a number of things that we're focused on over the next 12 months in particular as to how they play out and their impact on financial markets. And three of the high-level things are the potential for increasing in duration interest rates, the potential for the Chinese economy to slow far more materially than markets are expecting and we're expecting, and finally the same for the Australian economy as a result of that. And if I just deal with each of those very briefly, we've already seen a very, very large increase in 10-year bond rates that I mentioned earlier from May through to the current period, and that was as markets first price in the fact that rates should normalise from their ultra-historical lows. Now, it's the potential that they have over the next 12 months of increasing materially again, and that would have a very large dampening effect on the global economy as corporates have to spend a lot more money. Basically, their borrowing costs increase materially as a result of that. The second piece is China, just in relation to as they transition from an export-based economy to a internally consumer and services-based economy, and something they've been focusing on for many years. It's the question of how they do that and whether they're able to achieve that in the manner that they're hoping. We're comfortable that they've got in excess of $1 trillion of foreign currency reserves, and that gives them a very, very large amount of buying power should they run into trouble. But again, that balancing act that the Chinese government is running is something that we're focused on. And the final element is just the strength of the Australian economy. We've been a huge beneficiary now for close to the last decade of the resource boom. That's clearly rolled over, and the Australian economy is clearly going to slow from the strength of recent years as a result of that. Now, in a similar manner that as China's transitioning their economy, Australia will have to transition our economy from a resource-based economy driving growth to one where both growth is a lot more balanced. And that's going to prove a heavy challenge for us. But ultimately, Australia has a couple of things up our sleeve. We still have a currency which is relatively overvalued, and we still have interest rates which are at 2.75% and have capacity to be cut further. Both of these things will provide underlying stimulation as necessary. It's one of the reasons why the RBA continue an easing bias that they have at the moment. Similarly, it's one of the reasons why we have a view that offshore assets are preferable to domestic, both on the basis of the potential for the currency to continue to depreciate even from the low 90s, and in addition to that, a view that a number of the other developed markets have more robust economic growth going forward from the trajectory of the Australian economy at the moment. I just thought finally I'd take the opportunity to give you a couple of quick updates about the business as well. Over the last 12 months, we've continued to add to the resources of the firm. At the non-executive level, so at the board level, we were delighted for Chris Cuff to join the board. Now, Chris is one of the best-known finance professionals in the industry, having built Colonial First State from a very, very small basis into being a $60 to $70 billion investment powerhouse that it is today. And we were delighted for his expertise to be able to contribute to the firm over the last 12 months and ongoing. In addition to that, in the investment team, you've heard from Tony Edwards today. Tony's joined us in the last 6 months. He's responsible for the equities parts of the portfolio, and he has an extremely long and successful track record working for a number of high quality institutions, both domestically and offshore, managing equity portfolios. In addition to that, there's a number of other key individuals who have joined the investment team as we continue to build out the resources and continue to be excited about the range of available investment opportunities we have, such that the performance can continue in that consistent, predictable manner that we're seeking to achieve.